Hi, everybody. This is Dan Weisskopf, calling in on a Friday at a little after 5 o'clock. Thanks very much, Rick, for joining us today, and looking forward to a great discussion. For those who don't know me, I'm the ETF professor, also lead ETF strategist for the think tank, and co-portfolio manager of Block. With that, I'm going to hand off the mic to Cynthia to introduce herself.
Hey, everybody. I'm Cynthia Murphy, head of research for the ETF think tank. It is Friday. We are all counting the minutes here for the weekend, but it's always a good time to talk about gold and precious metals and all this good stuff. And we have the expert in the house to talk to us about the latest in these markets. So we're excited to have Rick join us today. Mike, you go next, and then we'll let Rick introduce himself.
Okay, so it's Mike Venuto. I've been away for a little bit, actually traveling. I was up in Toronto, but I'm back and excited to be on Get Think Tanked with my colleagues. I am the co-founder of Untitled Financial Group, where we help people launch and grow ETFs and work on a number of things, including a Sprott fund recently, which Rick's no longer there. He's retired, but he'll tell us more about his retirement in a little bit here. So with that, Rick, you want to introduce yourself?
Sure. I'm Rick Rule, long-time natural resources and conventional financial services investor. When I say long time, this will be my 49th year in the investment business. I tried retiring, and I did in fact retire from Sprott. I'm no longer an officer, director, or employee, although I am still the largest shareholder. In retirement, I run a property and casualty insurance business, an investor education business, and as you can see from my shirt, I'm part of my 7th de novo bank, Battle Bank, which I'm sure you'll all hear about soon. I need to visit with the people who scheduled me. I understand now that late Friday I'm standing between your viewers and happy hour, which probably won't stand me in high stead with them, but I'll do my best to keep them amused.
I mean, that's wonderful. Well, this is a happy hour, so I'm sure plenty of the people here are having a drink. I'm sticking with water today just because I've had a bit of a cold for a while. But I mean, you're known as a hard money person, uranium, silver, gold, all these things. I mean, that's part of Sprott. Hearing that you're still the largest shareholder kind of makes you our boss on one of the funds. Even though you're hands off now, but I really want to dig into the bank before. I know we're going to spend a lot of time on hard money type things, but how did you get involved with being part of 7 different regional community banks over the years, and why are you still doing it? Like,
I love the banking business. If I had to describe myself as anything, well, my formal title would be a credit analyst. My jocular title would be used money salesman. The part of finance I enjoy the best is the interplay between assets and liabilities, the deposits and loans. I have always thought that banking was a good business. I have always been attracted to banks that had some durable competitive advantage, be it a community bank around geography or a bank that had a specialized focus in terms of lending. In 1998, I co-founded a bank called Everbank, which was one of the nation's first online banks. Durable competitive advantage, no branches, saved 125 basis points off the top. Built the bank from 0 to 275,000 depositors and $28 billion in deposits before we sold the bank to TIAA CREF. We're doing it again. We aren't going to have 16 deposit products, most of which pay you no interest. We're going to have one, a high-yield money market account, which you can write checks against if you want to. We're not going to steal your interest in your checking account. Second thing we're going to do is we're going to have CDs available in 22 currencies, not just the US dollar. Interestingly, on the asset side of the balance sheet, the big banks don't seem to think that gold and silver are good collateral. I beg to differ. For people who have gold and silver in segregated accounts where we can affect sort of a collateral reach, we will have both credit lines and term loans available so that people who own gold and silver can take advantage of the liquidity of that asset, either to buy more precious metals or to use for some other purpose.
Wow. I mean, you gave us the transition to gold and metals, but it sounds like you're allowing the individual depositors to almost work with a royalty company in a certain way, right? You're turning them into being able to factor their gold. That's really interesting.
There are a lot of investors. It's an investor subclass I know well, which is to see people that are attracted to precious metals. I know any number of investors who you would like to borrow, who you would like to loan money to anyway, but they own $1 million worth of gold and silver. They don't want to sell it, but they have periodic needs for liquidity. Let's say that they want to buy a lakefront house and it requires $500,000 down payment. They don't want to sell their gold and silver. They understand that they'll be able to pay the $500,000 back over 2 or 3 years. We will loan them money against their gold and silver so that they could put down the down payment on the lake house. There are other people who have a belief in the timeliness of gold and silver investing. The consequence of that is that they'd like to leverage their existing holdings to buy more. Irrespective of the reason, the collateral is more important to me. Gold and silver are extraordinarily liquid, and gold and silver that are held in segregated accounts at well-known storage facilities, Brinks, Loomis, Viamat, places like that, superb collateral. So I'm delighted to do that business.
I think you answered part of my question was, you take possession of the precious metal when you're loaning against it?
We don't take physical possession. What we do is we file a UCC, Uniform Commercial Code, security interest in the gold. But the gold can't be let's just say it can't be buried in somebody's backyard. It has to be with a vault that's publicly traded so that we know the vault's balance sheet, income statement, financial statement. We want the gold to be there if we need to go for it. And we need to be in a vault that has auditing procedures that we're comfortable with and familiar with. An audit isn't hard. You go to a vault and you go 1 bar, 2 bar, 3 bar, 4 bar, but somebody has to do that. So it's important to us that we know the vaulting facility that houses the customer's bullion and our collateral.
All right, so I wanted to jump in just off of that. This is the ETF think tank. This is Get Think Tanked, right? That's our whole business. I'm curious, could $1 million worth of a gold ETF from a sponsor, maybe it's Sprott, maybe it's State Street, would that be collateral for you?
We would consider that, but normally ETFs that are exchange traded can be used as collateral for a margin account. What I like about the gold business is that, at least at present, I'm the only guy that's in the business. I've learned at age 70 that old, fat, bald me could win the 100-yard dash if I'm the only guy that shows up to run. If I provide margin loans against ETFs, I'm competing against Schwab and Merrill Lynch, and I'd prefer not to do that. I'd prefer to be the only guy running.
So this is a dumb question. This is a dumb question, but how come you are the only one doing it? Is it like particularly risky, or is it just nobody else has been that creative?
I have a theory. But my theory is that most bankers I've ever known are lazy. And they do at this institution what they did at the last institution. I was guilty of that, by the way. I cut my teeth as an oil and gas lender, and the collateral I'm most comfortable with is oil and gas because I grew up with it, which is to say I like them or lazy. But I also think that the last 40 years, the period of 1982 to 2022, probably the most benign financial markets in human history. Some punctuations like 2008, but strong dollar, declining interest rates, all that kind of stuff. It's been real easy, which is to say that not many people have had many reasons to be afraid. Gold does well. Gold comes into people's mind when there's financial turmoil. My belief is the next 10 years is going to be a lot different than the last 40 years have been. I'm not one of these doom and gloom guys, but I think that markets had the wind in their sails for the last 40 years, and I think that's going to turn around in the next 10 years, sadly, and I think that'll benefit gold. I suspect if we have a discussion 6 years from now, that I will not be the only lender in the gold space, but I'll enjoy my loneliness while it's offered.
So how do you deal with the volatility of the underlying asset, right? Like, I always, people, and it's funny because people think the treasuries are not volatile, and we just saw a bunch of banks disappear because they own treasuries. So it's not that different. But
this is a margin loan. First of all, if you think about it, think about a margin loan. Is there volatility in equities? But think about the implied volatility in other asset classes. People don't think that their house goes up and down in value. But if you had 3 different appraisers look at your house, believe me, you'd get 3 different numbers. Volatility is important, but liquidity is more important. And gold trades like water. If I needed to foreclose, the ability that I would have to turn my collateral into cash, the elapsed time would be measured in seconds, not weeks.
So
Yeah, Dad.
yeah, so my question maybe is a little bit off subject, so forgive me on this, but you've had great success in your career, and whether it's asset management or other businesses that you've been involved with, how do you get the word out? How do you distribute the products? What's your secret to success? Because at the end of the day, you can have the greatest product in the world, but how do you get it into people's hands and get them excited to be a part of it?
Dan, my secret's an old man. I've been managing my money and other people's money for 49 years. I have a thing that we used to call a Rolodex. Youngsters would call that contacts. At Sprott, we built a 250,000 person constituency around our exchange-traded products, one investor at a time. I feel like I raised that whole $25 billion, $1 at a time over 10 years. At Bank, we added 275,000 customers and $28 billion, one investor at a time. After 49 years, by the way, with some failures, not all successes, I came to know and be known by an awful lot of people. So as an example, with regards to Bank, the first customer base that we attract is the 275,000 customers that we sold at Everbank. With regards to the stuff that I do in my educational business, Rural Investment Media, my first target was the 250,000 investors that I attracted to Sprott. I guess you'd call that, in terms of a brand, retained earnings. I've done this for a very, very long time. For better or for worse, I don't have to build a reputation. That's all done.
I always love when people talk about the failures, and I don't know if I'm putting you on the spot, but like you can't talk about a failure without talking about what you learned from it. Yeah, I don't know if there's any in particular that stand out to you that like personally, I can point to certain things that I blew up and say, man, that led to us launching the blockchain fund and then launching this platform and that platform. So like, I love wearing them as a badge of honor. I'm actually bantering so that you have time to think of one, but yeah,
it didn't require any thought at all. The only question was, which one would I describe? You don't have time for a litany of my failures, but I'll give you the biggest one. I came into the investment business as a very young man in 1971, if my memory serves me well, at the ripe old age of 18. And I had an interest in natural resources. And as luck would have it, my interest coincided with the greatest bull market that we've ever seen in natural resources, the 1970s. The gold price went from $35 to $850. The natural gas price went from 30 cents a thousand to $15 a thousand for deep uncontrolled gas. I made a lot of money as a young man. And inexplicably, I confused a bull market with brains. I thought that my success was really a consequence of my genius, ignoring the fact that the commodity prices were up uniformly. The other mistake I made, because it was convenient for me to make it, is I forgot that markets work. I forgot that the cure for high prices was high prices, and that the cure for low prices is low prices. And I overstayed my welcome. All the big thinkers in the world, remember the Malthusians, the Club of Rome? Oil was going to be $200 a barrel in 2000, 40 million people were going to be starving every year. Well, all those guys were wrong. And I overstayed my welcome. I went from being extremely. I went from being a very wealthy, hubris-ridden, self-important young male to a somewhat more humble young man with a net worth that was sub-zero. And that was the most important lesson of my life. I learned that if you are going to be an investor in cyclical capital-intensive businesses, that you are either going to be a contrarian or you will certainly become a victim. And beginning in 1982, I developed a very strict, very regimented, value-oriented, contrarian strategy in natural resources. That has meant that I have always been early on the buy side, and I've always been early in the sell side, but I've captured a lot of great big fat chunks right out of the middle.
Love it. I love it. Yeah, my dad used to always say, "The market will make you humble," and I guess you agree. I don't know that he invented that saying, but yeah, I mean, Mike, to your point, kind of Menu was an ETF that I launched, right? That failed and brought me to the tank in a lot of respects.
Right.
So yeah, no, I want to come back to your successes though, and then we'll talk about natural resources, et cetera. Do you, when you're launching a business, as is the case with the bank business, do you have a targeted break-even period? You know, do you say, okay, I'm going to lose money for 2 years and then I'm going to evaluate things? Or because if you're starting a business, you've got to be prepared to lose money.
I don't. I have performance metrics along the way. And if I'm not meeting the performance metrics, then I abandon the effort. With regards to the Sprott trust business, I had an idea about how we could approach non-traditional financial media, how Sprott could use investor education and not spend money on things like banner ads, and how we could use independent publishers like Agora to spread our message in a way that education became advertising. Had that not worked within 2 years, had Eric Sprott and I not been able to get on BNN and not get coverage in the non-traditional media, had we not been able to attract big inflows of capital, we would have quit. The big underwriters that we had, the Merrill Lynch's in the world, the RBCs of the world, they weren't interested in gold at all. But when they started getting a bunch of inbound calls from their customers saying, can we buy this through you? In other words, when we made the investment bank's job easy, when they didn't have to raise money for us, when they had to write tickets for us, they suddenly became very receptive. So I would say that I don't follow a strict pro forma, but what I do is I put in place some performance criterion. And if I'm not meeting the performance criterion, then I reevaluate what I'm doing.
Yeah. All right, I'm going to jump in because that actually reminds me of a story, the story that brought me to ETFs, actually. And it relates to a couple things that I think we can go into here. Before starting Title, and before doing Global X, that was my in between. I was at a mutual fund, hedge fund place where in 2005, our biggest position was Newmont Mining. Right. You know what happened in 2005? Gold went straight up and Newmont went down. And the only reason we could figure out that occurred was State Street had launched the first gold ETF where people could get it directly. And that premium that was on miners disappeared. Right. For the first time in the US markets, ETFs had changed how people valued gold miners. So when you talk, you know, where you were just talking about in this cycle and picking the fat tail or outside of the fat tail, what do you do when there's a game changer? Like that was a game changer for gold miners. Like for gold, what happens if we figure out space mining? Like, how do you deal with game changers when you've been doing this 49 years, right?
I think you only have half the game changer around the mining shares. You've looked at that.
That's fair. That may have been one.
You've looked at that with that high, which is to say the ETF. And that was a game changer in the sense that individual investors would have access to the gold market without having to bury the stuff in the backyard or else buy Newmont. The other game changer was the extraordinary underperformance as companies of the gold mining companies. In the period 2000 to 2011, the gold price went from, if my memory serves me well, $256 an ounce to some number like $1,800 an ounce. The free cash flow per share in the XAU, the Philadelphia Gold and Silver Stock Index, fell. It took special skill to take an industry where the selling price of your product increases sevenfold and reduce the free cash flow per share. So some of the problems that you saw with select gold equities had less to do with the structure of the market and more to do with the structure of investor expectations with regards to management. I would say, in defense of the gold mining managements now, that virtually all of the people who presided over that destruction of equity have been allowed to pursue other employment opportunities. And the investors around the gold space are somewhat more focused on return on capital employed and somewhat less focused on the upside inherent in gold. But I think you need to examine the whole reason for the underperformance of the gold equities relative to gold.
But
You're
from that
so polite.
perspective-
Sorry, go ahead, Cynthia.
I was gonna
I mean,
say
you
from
just
that
said that they were all fired politely.
They're all losers. Got it. But so from that perspective, Rick, I mean, if you go on your website, at the very top, we have this really big question, which is, are you actually invested in the right natural resources companies?
Right.
So define for us what is right versus the wrong ones, to Mike's example. How do you go about that?
Cynthia, that really depends on the investor. Everybody looks for a one-size-fits-all answer, not understanding that with 7.3 billion carcasses on Earth, there's actually 7.3 billion answers. There are investors who have come to me in my active years who were highly knowledgeable about the exploration process, who were risk tolerant, who had lots and lots and lots of information. Those are not the sort of person I should show to a senior royalty company. There are many more people who might buy the narrative around some different commodity, be it oil and gas, be it gold, be it something else, but people who are generalist investors, people whose time preference might be different, somebody whose risk tolerance might be different, and I need to show them a different circumstance. What's important to note is that if you were constructing a beta-oriented portfolio, as an example, in the gold space, and you were looking to optimize, and you were willing to do some work, there's probably 6 or 7 companies out of a 40-company universe that you would focus on. You have to do work to get there, or else you have to hire some schmuck like me to do it for you. If you come down the quality chain, the performance dispersal curve gets worse. So as an example, if you came all the way down to the juniors, those sort of 2,000 companies that inhabit the non-producing public ghetto, there probably are 115 companies that might be viable. So the probability that throwing a dart, you're going to get the right company to suit your profile is sort of like 1 in 20. The truth is, particularly among the juniors, if you merge all of those 2,000 together, came up with a company called Junior Explorco, that company would lose between $2 and $5 billion a year. So how do you value that company? 8 times losses, 12 times losses, 15 times losses? Hidden within that ugly statement is the fact that the ones that are viable, the 100 or 115, generate so much performance that they add legitimacy and even luster to the sector. So you need to define yourself as a beta investor, somebody who wants to get involved in the space for the performance relative to the broad market that might be exhibited, or an alpha investor trying to outperform the sector. And you need to ask yourself how much risk you're willing to endure, how much volatility you're willing to endure, and what your time frame is. There are, and by the way, I was not a proponent for a long time of ETFs, for the simple reason that when I looked at a lot of the gold ETFs, people were purporting to charge me a fee, not purporting, people were charging me a fee, and they were including 20 companies in the portfolio that I wouldn't own with a straight face. What I came to understand, talking to literally thousands of investors, is that there were a lot of investors who wanted market beta, but they had lives. They had kids, they had books, they had jobs, they had houses, and they didn't want to do what I did in the gold space. And I came to understand that for those people, the ETFs, including the inelegance of owning market cap weighted stocks that are probably individually poor stocks, are a very good choice. So it really depends, in terms of the question that you ask, who the audience is that's asking it.
Well, either way, I do think you make a strong case for at least active management in the gold miner space. So, maybe that's a place to start.
I have found that when gold rewards you, it rewards you so extravagantly that you can make a fair number of mistakes and still make a lot of money. It rewards you only infrequently, though. So you either have to have some strategic sense or you have to be very active. I have had a very fortunate last couple of years in the gold space, partially because gold's done okay, but also largely because I was freed from my duty at Sprott, and I could spend more time in securities analysis and less time running what had become a behemoth. And investors need to decide what they can do and what's important to them.
Fair enough.
So moving beyond just gold, given your experience, what's your outlook on the various commodity categories right now?
Let me give you a broad overview. I think it's not unlikely. I don't think it's certain, but I think it's not unlikely that we'll have a recession at some point in time. I'm not an economist. I'm a credit analyst. But if we have a recession, that will hurt commodity demand and it'll hurt commodity stocks. I believe if you look out 5 years, which I'm by now of a habit of doing, that we have 20 years, 2 decades of underinvestment in a whole range of commodities, from copper to oil and gas to potash. And with no growth in demand, we're still going to have a shortfall in supply. So if you give me a 5-year time frame or a 7-year time frame, I can afford to be extraordinarily bullish on the whole commodity complex. If you give me a 1 or 2 year time frame, I have to be somewhat more selective. Here's what I know, and here's what I want to leave with your audience. The way that you make your money in the industrial material space, really make money, is you find a commodity where that commodity is necessary for the material well-being of humankind, where the selling price of the commodity worldwide is less than the cost of production. You actually look for an industry in liquidation, because in that circumstance, either the price of the commodity goes up or that material becomes unavailable. Let me give you an illustration. 3 years ago, or whenever it was, we were in the middle of this sort of COVID thing. The price of oil fell briefly to zero before settling out at $20 a barrel. The International Energy Agency will tell you that on a global basis, it costs $60 fully loaded to make a barrel of oil. That includes a return on capital employed for the investor. So it was pretty obvious at $20 a barrel that one of two things would happen. Your car would not start, or the price of oil would go to $60. What do you think is more likely? Precisely what occurred. During periods of low prices, the industry either won't or can't invest in sustaining capital investments. The low prices increase demand, and the low prices destroy supply, and the market responds. Similarly, during periods of high commodity prices, ironically, when all investors want to be involved in them, the seeds are set for their own destruction. Very high oil prices, $120 a barrel, makes consumers do something smart. They actually conserve. They drive less, at the same time that they draw out all kinds of supply. So when you look at the oil industry, or you look at the commodities business, they say they don't ring a bell. They absolutely ring a bell. It's just that the message is misconceived. At the top of the market's going to get worse. At the bottom of the market's going to get better. The same thing happened in the uranium business. People weren't only bored of uranium, they hated it. If I'd talk about it in a public forum, people would say, "You're a schmuck. You are profiting from Hiroshima and, 3 Mile Island and all that kind of stuff." 5 years later, when the price is up, those critics are asking me for stock picks. But the point is simply that when the price of uranium was substantially below the cost of production, irrespective of how you felt about uranium, it was 20% of the baseload electrical power in the Western world. So the choice was this: would the uranium price go up through $60 or would the lights go out? There was no intermediate. One or the other had to happen. You had to have the chutzpah to buy the industry when it was in liquidation, knowing that if it didn't come out of liquidation, civilization would end. These are really pretty simple equations if you look at them that way, and don't get too fancy.
And today?
Yeah, I'm going to go there too.
Silver, uranium.
There is nothing in the market today that's priced below the cost of production. The two most attractive parts, I would say, of the the three most attractive parts of the commodity complex are gold, which we can save for a later discussion, not because of supply and demand, but because of other factors. But I would say conventional energy, which is to say carbon. Coal, which everybody loves to hate. If you're a contrarian, you search for hate. And oil and gas. The investment paradigm around carbon has been set by the big thinkers. You know, President Biden, that noted energy physicist, what's her name, Greta Thunberg. These people would tell you that peak oil demand occurs in 2032. Let me give you some arithmetic around that. We have spent, over the last 40 years, $5 trillion on alternative energies. That's with a T, 12 zeros, right? Big number. And we've reduced the market share of fossil fuels from a high of 82% all the way down to 81% with a $5 trillion expenditure. What are the chances that alternative energies are going to make a market difference in the demand for fossil fuels in the next 7 years? Zero. Now, am I criticizing alternative energies? No, I've invested in them. There's 1 billion people on Earth with no access to primary electricity. There's another 2 billion people on Earth who have access to only intermittent or unaffordable electricity. We need every form of power, including fossil fuels. The political climate that we face today means that the cost of capital for fossil fuel companies is going up. That means they are deferring sustaining capital investments. That means that their ability to produce 2 or 3 years from now is constrained, which means that the price of oil, far from falling, will increase. Those companies that have made the sustaining capital investment so that they can maintain production 3 years ago will benefit. Those companies that haven't will be punished. Investors who understand arithmetic rather than narrative will be drawn to coal and more particularly to oil and gas.
You did say a very popular word in there that's of recent, which is uranium, right? That's one that everybody's gotten excited about. I keep seeing it trending on Twitter or X or whatever your social media sites is today. Is this irrational uranium exuberance, or what do you think?
The easy money's been made. When a commodity goes from hated to tolerated, the easy money's over, and the price of uranium has cleaned up from $20 to $80. The incentive price for existing production was $60. The incentive price for new production is right where we're at, $80. The uranium bull market has a ways to go for two reasons. One is there's a resurgence in nuclear power plant construction around the world. These are expensive. And if you're borrowing $5 billion to build a plant, the lenders are increasingly requiring you to lock in enough fuel supply for the next 15 or 20 years that you amortize the loan. That means that more uranium transactions are taking place in the term market with pricing security for the producer than in the spot market where prices are determined overnight. That increases the certainty that the producer has with regards to his or her top-line revenue, and it also increases the visibility around that revenue. So while the easy money has been made, the sure money is what's coming. It's important, however, that if you invest in uranium, you invest in companies that actually have some, as opposed to those little tiny piddlers who are looking for it. If the price of something increases that you don't have any of, it doesn't necessarily impact the value of your holdings. So I really want to leave that. When I see these discussions of uranium, I see people talking about, consolidated moose pasture, an amalgamated orangutan, and none of these companies have any uranium. They're just looking for uranium, thinking that the fact that they're looking for it should be relevant to a price increase.
I love this because, our core business is, helping people launch and grow ETFs, right? And we have talked with a lot of people about trying to get something in the United States market that has direct exposure to uranium, right? Right now, there are a number of funds that either own the beta, as you call it, a number of probably more uranium companies than they should, right? But there is nothing directly exposed to it in the U.S. market. well, a company that shall not be named has something like that in Canada. But
we tried to have
going to
that.
be a futures market.
That unnamed company tried that in the United States, but the Securities and Exchange Commission said it was a, quote, pioneer product. I guess because our prior approved products in the United States were redeemable, meaning that if you transferred the unit, we'd give you back the gold and silver. The SEC probably didn't want to see people try to redeem uranium. For defensible,
can I exchange for physical?
for defensible reasons. What's always struck me about the ETF business, and something that the Sprott board wisely never gave me leave to do, would be to launch ETFs in unpopular areas. I wanted to launch the uranium ETF a long time ago when nobody cared. There's always a dichotomy between what you can sell and what somebody ought to buy. And I'm always leery about launching in a sector where it's easy for me to raise money. Not always, but very often when people are willing to give you money, you'd be well advised not to take it, because what they're willing to give you money for is something that's already so popular that's in effect pablum. And that's something, it's something I no longer have to wrestle with because I'm retired. I just do what I want.
Well, if you want to come out of retirement and launch any ETF with us, we give it at least a 3-year runway, just like you were saying with your business model. So,
I would love to talk Sprott into doing a Canadian junior oil and gas ETF, sub-billion-dollar market cap ETF around, Canadian oil and gas companies. Oil and gas is out of favor. Americans think that Canada is some far-off jurisdiction. The Canadian industry is constrained by the idiot that they elected as prime minister. But they have wonderful geology. They have wonderful infrastructure. If I had to look at a subset where I thought I was going to make an absolute ton of money in the next 5 years, other than my bank, I would have to look to the small cap oil and gas producer in Canada, which I just think that's a laydown.
Yeah, it doesn't exist today. There used to be an ETF that was from Guggenheim that was Canadian oil sands, very focused on the small cap producers.
Yep.
It wasn't the Suncors. It was more like it was Canadian oil sands and names like that. But that doesn't exist. So whenever you're ready,
that's not me.
I'll get the ticker rule.
Yeah, I know you're gonna trot me out on another 100 city U.S. tour popularizing the ETF. Ain't gonna happen. Ain't gonna happen.
Right. You said you're
that's a young man's
semi-retired. You said you're semi-retired. I don't know. We can talk to you, I think.
Yeah, but the one I would love too is if we could get a uranium futures market. I've talked to Macquarie. I've talked to some Canadian banks. I don't understand when you have something where storage is an absolute scary thing, and it seems like there should be a really robust futures market.
There should absolutely be a non-term market, futures market in uranium. There is an existing standardized product. There are 4 locations that you could reference. There absolutely should be a futures market in uranium. It hitherto has been too tight, too constrained to market. In effect, it was Cameco selling to U.S. utilities. The truth is now it's a global market with producers coming from everywhere, but there being a standardized product, and there's consumers around the world. There absolutely ought to be a futures market in uranium.
I will put that on your bucket list too. All right, guys, we got about 10 minutes left here with Rick. Who's up next for a question?
I'm going to talk a little bit about silver. I was just today, before the show started, I saw this headline pop up about silver, quote unquote, next year being the explosive year for silver. All the ducks are aligned for a massive year. What do you think of silver right now? And, is it really poised for such a phenomenal year as some are starting to say?
The silver bugs are truly strange. They're like gold bugs that suffer from manic depressive, or, gold bugs on steroids. Either the stars are aligned and they want to get a third mortgage on their house to increase their silver supply, or they think that silver is a 4-letter word. They can't see it in the dictionary. And they seem to be warming up right now. Silver is a very difficult commodity to analyze, simply because, as an example, only 18% of primary supply comes from silver mines. The rest comes from base metals mines and gold mines. So to look at supply, you have to understand something about production trends in copper, lead, zinc, and gold. In other words, I guess what I'm trying to say is nobody knows. What I know looking back in history is that gold has to establish the precious metals narrative. The fear buyer establishes a bull market in precious metals, and that happens in gold. After the fear market has established pricing momentum in gold, the narrative appears to the greed buyer too. And the greed buyer plays off the fear buyer plays off the greed buyer, and we get that stupid, wonderful thing called a gold bull market. When that gold bull market is partly through, 30 or 40% through, the narrative spills down into silver. Silver is more volatile. It has a lower unit price, so more people can play. And when silver moves, it's always after gold, to the disgust of the silver bugs. It moves much further and much faster than the gold market. I believe that the gold price is going not merely higher, in fact, but much higher over 3 or 4 years. By the way, I hope I'm wrong. The set of circumstances that takes gold much higher does lousy things to the rest of my lifestyle. But that notwithstanding, I think that the gold price is going to go higher. I think the gold market's going to go higher. I think after some period of time, that might not include 2024, that the silver price goes higher too. The most volatile asset class in natural resources are the viable silver equities, because the population of them and the consolidated market cap is so small that when the generalist investor money comes in the space, to quote Doug Casey, it's like trying to siphon Hoover Dam through a garden hose. There just isn't room in the silo for all the cash that tries to crowd into it. I own silver speculations now, although I think I'm way early. I own them because I like what's hated. And the silver bugs have been so disappointed by silver since the Reddit silver squeeze of 2020 or wherever it is, that there's no speculative premium in silver at all. The adherents to silver hate it. And I love stuff that's hated. I love stuff that's hated where if the narrative changes from hated to neutral, I get a triple. So I'm long silver. I'm almost certainly 18 months early. I don't do timing, I guess, but I like the fact that it's dead.
I love it. It's I'm gonna go to an audience question. Mark Herbert's got one, but there's a lead in, which is, I've often looked at the crypto market,
right?
And liken Bitcoin to kind of that digital gold. And I've always said Ethereum's more like oil because you have to burn it and use it and do things with it. But in reality, the price movement's more like silver, and it's more like what you just described, right? It like gets pulled along. But Mark Herbert asked the question in the chat here. Well, basically your comments in this space, but will your bank lend against crypto at some point? I'm sure you got this question 100 times, right? Like,
yeah. What I've learned in banking is that you participate in businesses where you know more than the competition. And that does not describe me in crypto. There are lots of people, all of whom are younger, smarter, and more energetic than I, who know way more about crypto than I will ever know. And the idea that a 70-year-old fat bald guy could win a 100-yard dash against a 24-year-old sprinter in training is a non-starter. In addition to that, our bank is an organization in front of the OCC, the Fed, and the FDIC. If I had crypto in the description of the business plan, I would be waiting patiently for a charter till the end of time.
Yes, you probably would be.
Yeah, all those really well. All right, Dan, you had a question?
Okay, so I'll ask the question a little bit differently, twofold actually. I've got two questions. Do you have an opinion? Let's be specific about Bitcoin, because not all crypto is the same. Let's be honest about that. And then also, secondarily, as a question, when you're talking about gold specifically, right? When you're loan against a bullion, what's the loan to value ratio?
Let's do the last question first. Think of this as a margin loan. At the time the loan is established, 50% loan to value. If the gold price falls and it gets below 70% loan to value, the investor has 3 days to cure. If it gets 90 days loan to value, the investor has an hour to cure. Think about a margin loan. Sorry, I'll kill this. I hope.
It sounds like you're late on a loan.
I'm sorry. I was so emphatic with that second answer. I forgot the first question.
No, but by the way, just generally, do you have an opinion around Bitcoin directionally?
I no longer own any Bitcoin. Really for 3 reasons. It exceeded every level of greed I had on the way up. I had a 1-year target, which was met in 2 weeks. And if somebody gives me easy money for reasons I don't understand, I'm an old man. I take it. So I did that. I now try only to do things that I understand and where I think that my understanding gives me advantage over competitors. And that does not define Bitcoin. There are so many opportunities available to me today in areas where I believe that I have a definable competitive advantage, or at least if I make a mistake, I'll understand the nature of my mistake, that I'm really not attracted to 99.9% of human economic activity. I prefer to confine myself to my own little ghetto, where I've learned how to make my own little mistakes and make my own money. I'm attracted to crypto philosophically because I'm a libertarian. I'm a consumer of currencies. The idea that there's a whole bunch of smart people out there trying to get another currency that'll serve me better, I think is a wonderful circumstance. And I'm really attracted to the blockchain and distributed ledger. I think that the future of securities transactions and the future of commodities transactions will take place in the coin market. I'm talking 10 years out. And I've spent, by my standards, a lot of money in conjunction with the World Gold Council and Sprott around just that in precious metals. But with specific regards to Bitcoin, I'd have to be competing with people like you. I'm too old to start. I don't want to do it.
I'm glad I'm not competing with you. Listen, I think we're going to wrap up. I'm going to ask one last question and then we'll close out. And we really appreciate all your time today. I was saving this one, but I feel like you've already answered it with 2 other ideas. So I'm going to see if I can get you one more. You'd mentioned the junior kind of oil producers, and we talked a little bit about uranium futures. Is there a idea for an ETF that you think needs to exist in this space? Like, is there an asset class or an asset in the hard money world that you feel it's very difficult for investors to get access to?
I think a factors-based ETF among the major commodity producers. There's lots of large cap ETFs in natural resources, and they're market cap weighted. I think one that focused on reserve life and margin, that is $10 billion plus market caps that were in the top decile or top quartile with return on capital employed and production cost. That is, if you had a statistical way to give passive investors the best of the beta around the massive industrial materials company. That might be too boring for people. In other words, it might make too much sense to be marketable. The other one certainly would be Canadian oil and gas juniors in the 250 million market cap to 1 to 1.5 billion market cap. I have a very difficult time seeing why there won't be a wave of mergers and acquisitions there, accompanying a wave in increase in free cash flow.
All right. So when you're ready to launch, let us know. And thank you very much for being our guest. We really appreciate it. And this has been a wonderful conversation.
A pleasure. I hope that you'll allow me to invite anybody who's listened to this to join me at ruleinvestmentmedia.com. If you list your natural resource stocks there, I will, on a no obligations basis, including your ETFs, rank them 1 to 10, 1 being best, 10 being worst. If there are any individual issues that I think are worth commenting on, I'll comment on them. Once again, ruleinvestmentmedia.com. Thank you all.
Thank you very much.
Awesome. Thank you
Have a
very
great
much.
holiday, everyone. Thank you.
Bye, everybody.